The core principles of investment accounting at its foundation. Investment accounting involves recording, classifying, and summarizing transactions related to investments held by entities. These can range from stocks and bonds to real estate and derivatives, each requiring distinct treatment. The primary goal of this discipline is to provide stakeholders with transparent and reliable information about an organization's investment activities. This transparency supports strategic decision-making and ensures adherence to financial standards. A critical principle is the application of generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS. These frameworks dictate how investments should be valued, disclosed, and reported across different jurisdictions. Accountants must also consider the nature of the investment, whether it is classified as current or non-current, and apply appropriate accounting methods accordingly. For instance, trading securities differ significantly from available-for-sale assets in terms of recognition and measurement. Classification. Proper classification of investments determines the applicable accounting rules and affects financial statements. Misclassification can lead to misleading disclosures and regulatory scrutiny. Valuation. Accurate valuation is essential for reflecting true economic value. Market-based valuations often override cost bases during periods of volatility. Evaluating investment performance metrics. Performance evaluation is central to effective portfolio management. Key metrics such as return on investment, ROI, Sharpe ratio, and alpha help measure both absolute and relative returns against benchmarks. These metrics enable investors to assess whether their portfolios outperform market indices or meet predefined targets. They also highlight risks associated with various asset classes and time horizons. Investment accountants analyze these figures alongside cash flow statements and balance sheets to paint a complete picture of an entity's financial health. This holistic approach informs rebalancing strategies and capital allocation decisions. It is crucial to recognize that performance metrics vary based on the type of investment vehicle, for example, mutual funds versus private equity holdings. Customized analyses may be required depending on the complexity involved. Understanding risk adjustment factors. Risk-adjusted returns offer deeper insight than raw percentages alone. By factoring in standard deviation or beta coefficients, analysts determine if excess returns were achieved through higher risk exposure. Tools like the Trainer ratio further refine assessments by considering systematic risk rather than total volatility. Such nuances allow for better comparisons among diverse portfolios. Regular monitoring of these factors helps identify emerging threats early on. Proactive adjustments can mitigate potential losses before they escalate significantly. Challenges in modern investment accounting. The digital transformation era presents new hurdles for practitioners. Emerging technologies demand updated systems capable of handling vast datasets while maintaining data integrity. Cybersecurity concerns have risen sharply due to increased reliance on cloud platforms and automated processes. Protecting sensitive client information remains paramount amidst evolving threat landscapes. Regulatory changes pose another challenge. Staying abreast of updates from bodies like SEC or FASB requires continuous education and adaptability. Non-compliance could result in severe penalties. Furthermore, global operations complicate matters by necessitating multilingual documentation and cross-border compliance protocols. Cultural differences also influence interpretation practices subtly yet importantly. Leveraging technology in investment processes. Technology adoption has revolutionized traditional manual approaches used previously in managing investments. Software solutions now automate transaction processing, reducing errors commonly found in human entries. Artificial intelligence algorithms predict market movements with greater precision than ever before. Machine learning models assist in identifying patterns invisible to conventional analysis methods. Digital platforms enhance collaboration between teams located globally. Real-time access facilitates quicker responses to changing conditions affecting portfolio values instantly. Data analytics tools visualize trends effectively using charts and graphs. Interactive dashboards provide instant summaries useful during high-pressure meetings involving senior executives. Case study: automation success story. An international bank implemented AI-driven software to manage over $5 billion worth of client assets. Before automation, reconciliation tasks consumed nearly 60% of staff hours weekly. Post-implementation, error rates dropped below 0.1%, freeing up resources for strategic initiatives instead of routine checks. Client satisfaction scores improved by 28% due to faster query resolutions. Moreover, predictive capabilities enabled proactive management of currency fluctuations impacting foreign-denominated positions substantially. Losses avoided exceeded annual IT implementation costs manyfold. Regulatory compliance frameworks. Complying with relevant laws forms a cornerstone of sound investment practice. Different regions impose varying requirements regarding disclosure obligations and record-keeping procedures. Entities operating internationally face dual challenges, adhering locally mandated regulations while fulfilling consolidated group reporting mandates simultaneously. This duality demands meticulous attention to detail. Non-adherence leads to legal repercussions ranging from fines to operational restrictions imposed temporarily until rectification occurs fully. Penalties increase exponentially upon repeated violations detected during audits. To avoid pitfalls, firms invest heavily in training programs aimed specifically at keeping personnel updated continuously regarding policy shifts impacting daily workflows considerably. Ethical considerations in investment practices. Maintaining ethical standards safeguards trust between institutions and clients alike. Conflicts of interest scenarios must be managed rigorously through established internal controls mechanisms. Transparency about fees charged for services rendered builds long-term relationships grounded firmly in mutual respect rather than mere contractual agreements alone. Whistleblower protections encourage employees to report wrongdoing without fear of retaliation. Such measures foster cultures conducive towards self-regulation internally before external interventions become necessary. Codes of conduct outlining acceptable behaviors serve as guiding principles influencing day-to-day interactions among colleagues engaged in competitive environments regularly. Trends shaping future directions. Sustainable investing continues gaining traction rapidly. Investors increasingly prioritize environmental impact assessments alongside financial returns traditionally measured solely via monetary gains. Blockchain technology offers promising avenues toward enhancing security features inherent in digital record storage facilities currently plagued occasionally by breaches despite robust defenses deployed generally. Remote working arrangements post-pandemic reshape expectations concerning accessibility features embedded within enterprise resource planning (ERP) systems utilized extensively nowadays. Lastly, demographic changes prompt rethinking age-specific retirement plans incorporating longer lifespans anticipated going forward, thus altering pension fund structures fundamentally over decades ahead expectedly. Conclusion: investment accounting serves as a vital link connecting strategic objectives with tangible outcomes realized through careful execution aligned closely with prevailing norms governing industry standards universally recognized today broadly. Professionals must embrace technological advancements coupled consistently with rigorous adherence strictly following prescribed guidelines, ensuring longevity and relevance amidst ongoing transformations occurring dynamically across sectors globally affected profoundly thereby.